Now, while most people have a strong opinion either for or against stock buybacks, I don't think most people really have a good grasp of understanding what stock buybacks are and their implications of stock buybacks on the company and the economy. So let me start by breaking that down first with a very brief analysis over what stock buybacks are. Let's assume that this hypothetical company did $1 billion worth of revenue, and then they have, let's just say, $500 million worth of expenses, which means that they have a profit of $500 million. Now, when they have this $500 million profit, this $500 million sitting in the bank account, and then they have three things that they can potentially do with this cash. Option number one is they can save this money. Option number two is they can invest this $500 million back into the company. They can hire more employees, invest it in advertising, open more stores, invest in more manufacturing. Or option number three is they can give this money away to their shareholders. One way they can do that is a stock buyback. Another way they can do that is through a dividend. Now, option number one, which is saving the money, is actually the least attractive option for corporations because of the way that our tax code works. Our tax code will tax you if you save that money because that means that this money is your profit. You're taxed on your profit. And so now if this corporation has to pay a 21% tax on this profit, that means that they're going to have over $100 million going to the IRS, which leaves them with only $400 million. And now you might think, but $400 million is still a lot of money. Sure. But if you are running this company, $100 million can go a long way. You could use the money to hire more employees. You could use that money to open a new store. You can use that money to invest in more infrastructure. You can use that money to raise your employees' salaries. You can do a lot of things with this money, which is why so many corporations don't like saving all of this money because there's a very expensive cost to save that money. And so many corporations will opt out to saving a lot of money. Then option number two is investing this money back into the company. You'll see employees then do what I just said. Invest in more stores, more manufacturing, more whatever. That way they're putting this money back into the company. And if this company can spend all $500 million, maybe they spend it on a new advertising campaign or whatever. If they spend all $500 million, now they have $0 of taxable income and $0 of tax bill. And then they were able to use this $500 million more productively because they put this money back to work in the company, versus here, this is not being used productively because now $100 million went to the IRS. So it's not productive for the company because this company isn't getting the same benefit than if they took this $500 million and put it back into the company. Then option number three is they can take this money and they can give it away to the shareholders. So this company, let's assume, is a publicly traded company, meaning it trades on the stock market. That means this company is owned by the shareholders. If you go out and you buy one share of the Amazon Corporation, you become one of the owners of Amazon. Now, you might be owning the Amazon stock and say, you know what, I've been owning this company for a long time. I want to be rewarded for my ownership. Now, how do you get rewarded? Well, they can just give this as a cash payment to everybody for you owning the company. That's called a dividend. So now they can just distribute this money to the owners. Or they can take this money and they can buy back their own stock. Now, a stock price is determined by supply and demand. That means when you have more buyers of a stock, the stock price goes up. So now if this company takes $400 million, because now you have to pay taxes on this money, and they use this money to go and buy back their own stock, now you have $400 million or $500 million going to buy the stock, which then causes the stock price to go up, which now means that if you own the stock, you just made some money on paper. You don't actually make the money because, well, you have to sell your stock to actually make any money, but you saw your stock price now rise because this company just bought a whole bunch of stock, which then pushes the stock price higher, which means that your investment portfolio is higher, your 401k has grown, your retirement portfolio has grown. Your stock now is worth more money because now they bought some of the stock back. Now, if you sold the stock, well, now you have more of this money in your pocket, but in your portfolio right now, it shows that you just made some more money. Now, before I explain why this is so interesting, let me also mention taxes really briefly, because now when this corporation takes this $500 million worth of profit and now they want to buy back their own stock, well, first, the corporation is going to have to pay taxes on this money, which means that they're going to be left with just under $400 million, because right now at the time we're recording, the corporate tax rate is 21%. So 21% of this money is going to go to the government. Just over $100 million goes to the government, which means they're left with just under $400 million. Now they can take this $400 million and go and buy back stock. But now we have this new 1% tax on corporate buybacks, which means that if the corporation buys $400 million worth of stock, 1% of this money is going to go in taxes. And then if you own stock, whether it's through your 401k or your retirement accounts or your stocks, now when you make money here and you sell your stocks for a profit, then you're going to have to pay taxes as well, because now, well, you made money. Now, the way you pay taxes is going to depend on where this money is. If it's in your 401k, well, it'll be taxed differently than if it's in your Robinhood account or your E-Trade account. And so it's going to be taxed very differently depending on how you're investing your money, because 401ks and IRAs have some special tax rules that they can follow as well. But just understand the tax levels. You pay taxes here when the corporation makes the money. Now you have to pay taxes when the corporation does a stock buyback. And then when you make money, whether it's through a dividend or when you sell your stock for a profit, you also pay taxes on that as well. Now, this is where things really start to get interesting, because what we've been seeing happen is corporations have this situation happen. They make $1 billion, they have $500 million worth of expenses, you have $500 million worth of profit, which then you pay taxes on. But instead of doing stock buybacks at $400 million, they say, you know what, we're gonna do something called a levered corporate buyback. We covered this pretty heavily in market briefs, so if you've joined market briefs, you should know what I'm talking about. But a levered corporate buyback is now where the corporation says, we have $400 million worth of profit. We can go to the bank and say, hey bank, we have this big profit, we have all these revenues, we have all these assets, can you give us a loan? And the bank will say, sure, we will give you a loan of $600 million. So this B is the bank gives you $600 million, and now instead of doing a $400 million corporate buyback, the corporation does a $1 billion corporate buyback, because now they're going into debt to do this corporate buyback. And now you have a 1% tax, not just on the $400 million, but then on the debt as well. And the reason why that's so interesting is because debt normally isn't taxable. This is what we talked about in Market Briefs. If you haven't joined Market Briefs, which is my free financial newsletter, I highly recommend you do so, because it's an easy way for you to stay up to date on what's happening in the top financial news. We cover what's happening in the economy, the stock market, the housing market, and everything you need to know as a retail investor. You can read it in less than 5 minutes every morning, and it's completely free. So if you want to join Market Briefs, I'll put the link to how you can join down in the description below. If you enjoyed this short clip from my longer videos, here's another clip that I think you'll love. And while you're at it, if you're interested in learning more about how to start generating passive income, our team put together an amazing guide on how to start generating passive income for free. All you got to do is click that button right over there. Thank you for watching, and as always, keep hustling.